This webinar series is called Next Steps, and it's a practical roadmap that GPN Technologies has been hosting, this being the third session, to try to help you get to a back to business mindset. Today's session is called Digging Out, and we hope to provide a financial analysis plan for ECP business owners. My name is Scott Jentz. I'm a doctor of optometry with over 25 years of clinical practice and ownership experience, and have been a longtime state and national optometry volunteer. After that, I was founder and former CEO of a cloud-based software company for eye doctors, from which I retired in 2018. And I now serve as a senior executive coach to the GPN Technologies team as part of my business coaching service called Sandbox. It's a real pleasure to introduce a friend and today's features expert, Dr. Mick Kling from California. Mick is the eye care business owner of Envision Optometry in San Diego and has a wonderful reputation for providing conscientious business advice through his consulting business called Impact Leadership. Mick, I'd like to thank you for joining us.
Scott, thanks so much for having me. I just want to tell everybody, say thank you to you and everybody on the GPN team for this opportunity. We just so appreciate the ability to be able to share information with one another. So really looking forward to getting into it with you.
That's great. Today's session is sponsored by Eye Care Advisors, and I'd like to talk a little bit about the webinar. We're going to try to aim to help you create an effective financial recovery strategy. We talked in the last session that everybody is in this together. Nobody has had a secret method by which they have found success and continual operations over the course of the last 4 to 6 weeks. And Mick's presentation is going to cover these 4 areas of determining your working capital, looking at your cash burn rate, developing a 90-day recovery budget, and looking at your vendor relationships. So with that, I'm going to monitor for some of the questions that will come along, and our expert, Dr. Mick Kling, take it away.
Awesome. Scott, thank you again for having me. Listen, I want to just say welcome to everybody that's joining us today. I'm really looking forward to just sharing a few things that are on my mind over the next few minutes with you. And the first thing that I want to just go through, I've done a number of webinars over the last couple of weeks, and I've shown this slide a number of times, and I so appreciate and like what this says. So let me walk you through this for just a minute. This was created by a business author named Mike Michalowicz, and basically what this shows is what a typical business goes through when it's facing crisis. And the very first thing that happens when we fall into business crisis is there's this immediate shock and freeze. It's almost a sense of panic where we just don't know what to do. That stage of a business crisis leads to inaction. And I remember thinking back 10, 14 days ago and where my mind was at that time and thinking, I don't even know what to do. I'm paralyzed. I'm stuck right where I am, and I'm in this place of inaction. And a few days later, as things started to evolve, the emotion of everything that was happening really, really hit me. And I remember just sitting in my office and just becoming almost breaking down, thinking, what am I going to do with my business? What am I going to do with my team? We were contemplating furloughing 27 employees. I had this real sense of desperation that I was dealing with. The second stage of this crisis is probably the most critical for us to have gotten through. And I think most of us have gotten through this because this is where we tend to make really bad decisions. This is where our emotion takes over. We tend to not see clearly because of the so-called fog of war. And so we don't even know what to do. I got a number of emails and calls from ODs saying, should I just file bankruptcy? That would be the absolute worst thing to do. But that came from a position of emotion and desperation where we tend to overreact. As we move out of stage 2 into stage 3, we come into the stage of evaluation. And this is where we all sort of began to accept to some degree what was happening to us and started to look around and say, okay, this is the new reality. What am I going to do here? What's really happening? And this is where the PPP loan started to pop up and all the questions that were in and around that. And we started to consider, is this something for me? And what should I do about it? All along this course, we are vulnerable to making some bad decisions and taking some wrong actions. As we evolve out of evaluation, we come into the 4th stage, which is deliberate action. And this is where I believe that we are right now. Most of us have come out of the stage of desperation and we've been in evaluation, and now I'm seeing a lot of the questions that are being asked have more to do like, what are we going to do on the recovery side? We've all sort of realized we're going to get through this, so now what's going to happen on the backside of this? What actions do we need to take? This is where we also need to be very careful, because it's possible that we could end up making some bad decisions in this phase as well. But as we cycle out of this evaluation stage and into deliberate action, that is going to rocket us into a surge or a burst into business continuance. So I wanted to just share that with you and tell you that I believe we have all gotten through the shock and desperation. We've spent some time evaluating, and now it's time for us to take some deliberate action and start thinking about what our plan is going to be as we start to move forward into the next phase.
Mick,
yes.
Can I just interrupt?
Absolutely.
Let's just assume that 10 or 20% are still in desperation or evaluation mode. What would you say to them right now? Because there's some of our colleagues who are still really unsure and concerned. So yeah. I want to be positive. I really do. But I think a positive statement to that 10 or 20% of attendees out of your voice would be wonderful.
Yeah, great question. And you're absolutely right. There is a small percentage of us that I think are still feeling that sense of desperation, especially if you didn't get the PPP loan. And I know that a lot of people are banking on that, and many didn't. By far, many more of our colleagues did not get it. And I think a lot of us might have been counting on that. And when that didn't come through, there could have been another sort of emotional setback. I would tell you that just remember, this is a process. This is a series of stages that you're going through, and give yourself a break. Try to step back out of the emotion of the situation you're in. And having gone through 3 economic crises over the last 25 years of my own professional career, I've come to believe that this is a true cycle that's going to occur, and that we are going to pull ourselves out of it. So if you can pull yourself out of the emotional part and get in that prefrontal cortex part of your brain of sort of analysis, I think you'll just feel better about pulling yourself out of that stage 2 and getting yourself into stage 3. The sooner you can get into stage 3, the sooner then you can obviously propel to stage number 4. So just stay in there.
And we have hundreds of attendees who I think are committed to that. And I've seen ahead of what you're presenting today, and I think you're going to give everybody a very tactical set of activities to do, which gets them into stage 3 right away if they are lagging. So keep going. Thank you.
Absolutely. And it's sometimes that feeling of desperation can be broken by taking action. Just getting up and moving, physically moving our body, or getting up and doing something will actually be enough to pull ourselves out of that state that we're in. So I want to share this with you too. This is the late Jack Welch, who was CEO of GE. His wife Susie wrote a book, and it's called 10-10-10. And the premise of the book basically is, consider how every decision might impact the future. And so again, this is a tool that you can use to sort of pull yourself out of the moment, out of the emotion of where you are right now, and think about every decision that I'm going to make, how is it going to impact me at some point in the future? One of the hardest decisions that we made was in and around closing the office and laying off our staff. That was a very difficult decision to make. And in the moment, it was a very painful thing to do. But in 10 months from now, and certainly in 10 years from now, I think we're going to all look back and say that was probably the right thing to do. That was probably the right decision for us to make. But again, in the moment of the emotion of what's happening around us, we couldn't see clearly. I got lots of calls about, should I borrow money? Should I take out a loan? And I kept advising people, just sit tight. Don't go run out and borrow money, because while it might make you feel good right now to have that money in your bank account and relieve some of that anxiety that you're feeling, how are you going to feel about that loan in 10 months from now or 10 years from now, when now you've got to pay that back? And so in the short term, again, it gave you some relief, but in the long term, it might end up being a bad decision. So I love this tool. It's very simple, but everything that you do, every decision you're going to make going forward, we want to make sure we think how it's going to impact us in the moment, a few months from now, and a few years from now. And I think that's going to avoid us falling into those pitfalls as we do climb out of that business crisis curve that we just talked about. So what does financial recovery look like? Well, in my perspective, there are a number of things that we can do right now. There's some action that we can take deliberately right now to start the process of recovering our businesses from a financial standpoint. Those are determine our working capital, which is how much money do we actually have, measure our cash burn rate, which is how quickly are we consuming money. Think of money as oxygen, and our businesses need cash just like we need oxygen to breathe, and we are consuming cash every single day. So we need to understand that there's a limit to the cash and how quickly are we burning through that. And then what's a 90-day recovery snapshot look like? In other words, if we're going to do some windshield accounting, meaning we're going to look forward into the future, what does a 90-day recovery look like? And then finally, we have dug a very serious hole with our vendors. I know in my practice, we are multiple six figures in debt with some vendors, real estate debt, frame bills, lens bills, contact lens bills. We've got a massive, massive hole that we've got to dig out of. And one of the things that we're going to talk about a little bit later is we cannot continue to run the business the same way that we have historically, because our profit margins have been so thin, they don't give us the resources in order to dig out of those holes. So those are the four things we're going to try to tackle over the next few minutes here. So the very first thing that I think we should do is stop and do something called a liquidity report. So I know most ODs are not, don't have the mindset or any interest in math and in accounting, and that's perfectly fine. But I just want to walk through this with you because I think this is super important that you really understand this concept of a liquidity report. What we're trying to do is determine something called our working capital. And here's what our working capital is. Our working capital says we have a certain amount of money in our presence right now. That's probably sitting in some bank accounts. You might have one operating account, or maybe you've got a couple of reserve accounts or one reserve account, but you've got some cash on hand that you haven't spent yet. You also have some bills that are due in the next 30 days. And what working capital is it's a measure of the difference between those two numbers. So let's take a look at this example up here. In the very top part of this slide, we have three bank accounts. We have an operating account, a reserve account, and a savings account. There's a little bit of money in each of those accounts. Now you'll see that I have an account balance number, and then in a column just to the right of that, we have a financial software balance number. Those two numbers might be different, and here's why. If you use QuickBooks for your accounting, for instance, that's going to reflect any checks that have been written out of your business that have not yet cleared your bank account. So if you pick up your cell phone like we all do, and you check your bank balance like we all do every day, that number that's in that bank account is possibly not a true reflection of your true cash position. So you want to make sure you cross-reference that with your financial software to make sure that you have a true indication of how much cash that you really have on hand. So we add up all the cash that we have on hand, and the next thing that we do is we take a look at all the bills that are due in the next 30 days. We might owe some vendors, we might have some frame bills due, we might have some lab bills due, maybe some contact lens distributor bills. We may have some payroll due that's, we've kept a few people on payroll possibly. Maybe we weren't able to get a deferment on our rent, so we've got some rent and utilities that are coming up. And then there may be a pile of miscellaneous bills that, in addition, that we need to make sure that we cover. All those bills, we want to total those, and in this example, we have some frame and lab bills. We've got some rent and utility bills and some miscellaneous bills. So what we have here is $25,000 worth of working capital, or with the cash available, and we have about $8,500 worth of working capital. So that's the money we have minus what we owe in the next 30 days. That means that technically we only have $8,500 to our name. Although we pull up our phone and we see $25,000 in the bank, we've got to remember we still owe those vendors, unless we're going to default on those bills, the $8,500, the $8,600, the true number that we have of working capital or the amount of cash that we have to work with. So very, very important that we take a look at the liquidity report and see what we've got on cash on hand. Okay, let's move on to the second one. And the liquidity report ties into this next example that we have, and that is determining something called our burn rate. Here's what our burn rate means. New businesses that start, a new startup company, generally doesn't have any revenue, but yet there's expenses related to running that new startup company. And in the investment world, they call that the burn rate. How much cash are they burning through every single month to keep the business sustained until they can get the revenue to the point where it exceeds the amount of money to operate the business? That's called the burn rate. The example that I'm going to show you is called the net burn rate. And the reason we call it that is because most of us probably have some revenue in the practice. In my practice, we still have some contact lens sales that are happening every single day. So some revenue is trickling in. We've got a few insurance reimbursements that are still trickling in. So we've got a little bit of revenue that's coming into the practice. And so that's very helpful for us to help support the business. What we want to do is calculate how quickly we're consuming that little bit of revenue that's coming into the business. And we do this with a burn rate calculator. And this is just a simple one that I designed for Vision Source. So if you're a Vision Source practice, these are available to you on Insight. But you'll get the example here in that in this example, in the month of April, we were 12 days into the month, and on the 12th day of business in April, we had collected about $6,000 worth of revenue into the practice right here. Now, if you take a daily average of this, that's about $512 per day on average that we're bringing into the practice. Now, you might have a few people that are still on payroll. I know a lot of practices have chosen to either keep the doctor on payroll, maybe one or two key employees on payroll. If it's the case, you are still paying them to be there, even though you may have furloughed the rest of your team, and that is consuming cash out of your business. And so what we do is we enter in their monthly wage and then calculate what the impact is on a daily basis right here. So we've got income of about $512 a day. We've got some nominal expenses related to payroll here. And then you may have decided that you are going to maintain some very basic, critical expenses within your practice. Maybe you still need to pay rent. Like we mentioned, maybe you couldn't get a deferral. Maybe you want to pay your custodian or the person cleaning your building to make sure that it stays clean, and you want to have your IT company paid because you've got to have your computers up and running, and insurance premiums for your employees that are furloughed. So there could be a number of things, of expenses that are still occurring, and we can look at that and break that down on a daily basis. And in this example, we have $6,192 in monthly expenses, or $940 a day in expenses when we add up all those expenses. What that tells us is that we are consuming $428 of cash every single day. We're collecting $512, but we're spending $940. So we're in the hole, we're in the negative $428 every single day. Now, if we take that number and we divide it by our working capital, which we got off of our liquidity report, we can actually calculate that we only have 20 days left in business. Okay, I'm going to say that again because sometimes that's hard to get your head around. If we only have about $8,500 worth of working capital and we are burning $428 a day, we can only continue doing this for 20 more days, or the business is going to be insolvent. In other words, we're going to be out of business unless we take out a loan. So I share this with you because I think it's very important for us to understand that although you might be selling some contact lenses and we're feeling good about that, if you still have some expenses, you could be in a negative situation with your burn rate and find yourself consuming your working capital at a much faster rate than what potentially that you were aware of. And so it's just something that you need to be highly, highly aware of.
Mick,
so,
this is Scott.
Yeah.
Let's talk about two things from these last two slides. First, This is probably a worksheet activity. A person could do this on a piece of paper, I assume, going into their accounting software, working with their business manager if they don't know how to get into their accounting software to get a sense of their cash balances. Would that be a fair way to think about how somebody could practically start that exercise, the working capital exercise?
Absolutely. You do not need a spreadsheet or anything sophisticated or a financial tool to do this. You can literally take out a pen and a notepad.
Yep.
And as Scott mentioned, it just take a look at your numbers and say, well, how much have I collected so far this month? How many days are in that month, and divide that to get your daily average, and then calculate how much you're spending throughout the month and work backwards, divide by the number of days in the month, and you'll get your daily spend. So it's really just a very simple mathematical task that you can go through. You might need to get your CPA to help you if it seems a little bit complicated or overwhelming, but it's really pretty simple math that all of us are capable of doing.
And then the second question is sort of it's got two parts. So A is, when I think about the expenses that I have over the course of the near term, that's a very individualistic decision. For illustrative purposes, you've shown that perhaps you'll have 4 people on payroll, or you might pay part of your rent, or you might pay part of your IT services. But the simple version of that is, I think what I heard you say is you, business owner, get to decide which expenses you have, how much of those you're paying
Yep.
in April or May, and just divide them out over the number of days until you think you're going to be back at it, right? Or divide them into the working capital you have, the number of days you get to pick your expenses is another way to say it. Is
Yeah,
that right?
that is correct. And we're going to get into that in just a couple minutes about, like, now that we've created this hole with our vendors, how do we decide who gets paid back and who gets
Yeah.
first and who gets priority? That's a really important part of this, because we've got some limitation to the amount of capital that we're going to be able to work with. Because one of the big unknowns for all of us is, in this recovery phase, as we all start to get back to work, we don't really know how fast we're going to ramp back up. In other words, are we going to go at half schedules?
Mm-hmm.
Are our patients going to be reluctant to even come visit us? Or on the other side, is it going to be this massive pent-up demand that we just are bursting at the seams? I don't think any of us quite really know what the volume of recovery is going to be. And so we don't really know exactly what we can afford to pay back. So we have to start to make some projections into the next 90 days or 180 days, however far you want to go. And that's perfect lead into my next little tool here that I want to share.
So there is
with
a
you.
B. I'm sorry, there's a B part to that question. So that was on
Yeah.
expenses, and you'll get back to vendors more. There was a question that specifically said, okay, so I've gotten some PPP dollars, right? So now they can add that to their working capital, and it can give them an extended opportunity to pay, but they need to use it for certain things. GPN Technologies is all about data and dashboards, right? The Edge Pro dashboard and helping a business run on a metrics-based approach. We aren't here to be PPP experts, but it would be fair to say, I think, Dr. Kling, that in the case of PPP, the doctor that gets that would just add it to their working capital and realize they have to spend it on payroll or rent, right?
Absolutely. I'll show you in this next slide. I'll show you kind of what we're
Perfect.
doing to address that.
Thank you.
So the third sort of look forward strategy that I would recommend is start thinking about what your next 90 days might look like. And again, this is a tool that I created for Vision Source. So I'll just show you an example just for illustrative purposes. So what this top left section over here is basically the projected revenue, or the cash that we think we're going to have coming into the practice over the next 90 days. And the way we look at this is that we take a look and we say, historically, this practice has been used to collecting about $75,000 in revenue per month. That's just been our sort of our normal business. We are anticipating a 50% reduction in business in the first month of recovery. And so although you can't see that under that red circle there, there's 37.5, which is 50% of the 75. So we think from operations, from doing eye exams and selling glasses and contact lenses, we're going to generate about $37,500. Now, we may have gotten some stimulus money. And in this example, we got a $50,000 PPP stimulus, and we infused 30,000 of that into working capital in that first month. So our total revenue, although that's not the most appropriate word, our total cash available is $67,500 in this very first month. So now this is what we have to work with. And what we're doing is that we're anticipating in month 2 that maybe our anticipated reduction in practice revenue is going to only be 40% as we ramp up. And by month 3, we're only going to see a 20% reduction. And so as our practice recovers, our revenue from operations starts to recover, and our availability from the stimulus money starts to go away, because we've got to spend this in the first 2 months right here. So this gives us an ability to sort of play around with some numbers and say, what do the next 90 days look like? So that's on the income or the revenue side on the business. So let's look over here to the right on the projected expenses. So if anybody's ever seen me do my business acumen training, numbers a lot, but I like simple numbers. I am not a complicated numbers guy. I like the numbers really simple. And I think of our expenses in an optometry practice as 4 buckets. And those are cost of goods, which are frames, lenses, and contact lenses that we sell. And then the other 3 are people, place, and things. So our people are all the human resources that we hire and all the expenses around people. Our place is all of our occupancy costs. And our things are just everything else. We just lump that into one giant bucket of expenses for simplicity. And so we built this tool in such a way that we can take a look and we can enter some historical data about our practice. And in this example, our historical cost of goods has been 28. Our historical things expense has been about 12. Our historical payroll has been about 18,000, and our historical place has been about 5,000. Once we plug these numbers in, then each month we can play around with reduction in spend. In other words, if I were able to get a portion of my rent deferred, I can enter in whatever that reduction in rent is here, and in this next column it will tell me what the actual spend is for that month. And so we can do this going forward for the next 3 months and play around with all kinds of scenarios. Now let me tell you something that I've discovered having done this a number of times already. 2 things. One is doctors, owners, we collectively are going to need to consider our own owner's compensation in this equation, because here's what's going to happen. In 60 to 90 days from now, we are going to feel a significant cash flow pinch. And here's why. As the business ramps back up to full capacity, we are going to start incurring expenses related to that growth back into business. And so as the recovery starts, our expenses are going to trail right along with it. The problem is, not only do we have our normal operating expenses that go along with that business that we're doing, we now have, in addition, all of the in arrears debt that we have with our vendors, all the catch-up that needs to be required. And in addition to that, we have the lag of insurance companies paying us on the receivable side. So this is the perfect storm. 60 to 90 days from now, the perfect storm is going to happen where we've got lots of expenses flooding the business, and there's this lag in our revenue coming into the practice. And so doctor owners, I want you to consider what you might need to do with your own compensation. And as weird as this sounds, I've modeled this enough times. The way it works in my practice is that me as the owner actually needs to, over the next 60 to 90 days, decrease what I personally take out of the business instead of increasing it, because the logical thing is to think, well, I'll take a little less now, and next month I'll take a little bit more, and next month I'll take a little bit more. The way I've modeled it is it almost always comes out to be the opposite, that really we can afford to take a little bit more now because we've got the infusion of the stimulus, but next month that may be less, and the next month it may be even tighter. So I want you to just think about your own personal compensation that you're pulling out of the business. And then this also allows you to model some different debt service if you were able to get some deferments with some of your vendors. And then finally, Scott, on this bottom left over here, this is our accounts payable catch-up. And what this does is, although this is broken into 3 sections here, if you can imagine this just one long vertical spreadsheet, at the very bottom of this, we've listed all of our vendors that we're in arrears on, and it allows us from a cash flow standpoint to predict how much we can afford to pay over the next 3 months or possibly even longer to make sure that we keep our business in a positive cash flow situation. Because again, you might owe a vendor $10,000. We can't really afford to pay that $10,000 all at once. And if the way you're managing your practice is with bank balance accounting, which means I look at my bank balance and I decide what I can afford to pay, you're really not going to have clarity about what really is available for you to pay the vendors. And you might see a pile of money. Hey, I just got PPP. I'm going to write that big check. But that may not be the best strategy for you over the long term. And you may be better off spacing those payments over the next 90, 120, even maybe 180 days. So the point, Scott, in sharing this 90-day recovery plan is I just want to point out a couple things. We need to be looking forward and thinking about how we might need to adjust some expenses in the business. We might need to think about our own compensation and how that's going to impact everything. And then we might need to build into that plan how we're going to slowly recover with our vendors that we're now in arrears with.
Okay, let's do lightning round. 3 questions.
Sure.
As you develop these catch-up plans on your payables with your vendors, you're going to be, starting to spend more with your vendors on cost of goods, right? I mean, you're going to get back to selling frames and contact lenses. I guess the point that somebody was making is keep that in mind. That's just one thing that was said. Maybe that's not so much a question. Any comments to that?
Yeah, that's exactly my point. That's why that 60 to 90-day cash flow pinch is going to be so critical, because let's say you're in arrears $10,000 with a lab. Now you start to do business over the next 3 months, you might owe them another $20,000 on top of the 10.
Right.
So now we've got our less than normal revenue, or even if we're back to a revenue state of where we were before COVID, whatever that revenue state is, it cannot support 3 or 4 months of lab bills.
And I was part of a practice where the co-owning partner and we were equal partners, reduced our salary, different circumstances for about 3 months. It was one of the hardest decisions I ever made at the time. This sounds a little harsh, but I felt in hindsight, I was kind of selfish. And I think your words of advice are very important, that if you think about sort of dialing your personal takedown a bit over the course of that 60 and 90-day period, that is a wonderful way to get through it. It takes great planning and a little bit of sacrifice, but it's an easy lever to move.
Well, it absolutely. And no doubt there may be some folks out there that it may have remembered last fall, you guys had me on to present something called Profit First, which is a cash flow management strategy that I teach. And one of the tenets of Profit First is that we prioritize profitability, our own compensation, and our tax liability over and above the operating expenses of our business. And that forces us to learn our business on what's left. And so it changes human behavior. So this might sound a little counter to that the Profit First strategy. But if you are using Profit First as a cash flow management strategy, I will tell you, as long as you can continue to make the allocations as usual, I would do that. And here's why. Because it's based on a percentage of your revenue, which your revenue is way down, the amount going to owner's compensation is way down as well.
Yeah.
For people not using Profit First, let's say they pay themselves a guaranteed wage every single month, those are the people that I'm concerned about. Those are the people that got to be really careful that, well, hey, listen, I'm used to pulling $10,000 a month out of my practice every single month. I got a mortgage to pay and I got kids to feed. Those are the people that you've just got to be careful what the drain is on your business, because you're gonna starve it for the oxygen that it needs in the form of cash flow.
Second of the 3 questions, you alluded to it. The question was not related to your illusion. You made a comment about using PPP money to pay off vendors. There's a very specific use protocol of the PPP, and the question that was asked was, what if you decide not to spend 75% on payroll and rent and use the PPP money for something else and assume the 1% loan? From a financial perspective, there's certainly a trade-off there. You have any quick comments to that person's question?
You know, I would tell you, Scott, over the last 10 days, I have been consumed with, because we're building a PPP repayment calculator, and I've been consumed with this idea of loan forgiveness and trying to figure out how to calculate the repayment. And you're absolutely right. It's got to be 75% has to go for payroll, 25% goes to non-payroll, which is rent or mortgage interest, utilities, and some interest on debt that you had prior to COVID. And so that needs to be tracked very carefully. The question always is, can I not just take a 1% loan? It's deferred for 6 months. Interest does accrue, but then I've got 18 months to pay it back. Sure. I mean, that is a strategy, but remember, it's a loan and you have to make the payment. And 18 months to pay back $50,000 in this example is a pretty high
Sizable. Mm-hmm.
monthly payment. So before you go buy a Tesla, just remember you have to pay it back. You don't have 5 years or 10 years or 30 years like the EIDL loan gave you. So if you do decide to just take the money and not spend it as it's intended, obviously just consider the ramifications. Also, I just can't help but comment. I just want to remind everybody that what the purpose of the PPP was. It was intended to keep our employees off of unemployment, and this is now, because of the fumbling of the government, this has turned into now a big strategy for everybody to try to figure out how to strategically bring people back and strategically spend the money. Just remember what the spirit of this was for. It's really not a free money for you. It's not, although it's turned out to be free money for a lot of people. Most optometrists, that is not the case. So just keep that in perspective.
Well said. Last thing is related to some of your revenue expectations, and I know you're moving on to vendors, but we can't help but get a question or two about vision plan participation, maybe needing to change. This session is not about the profitability of vision plans, but a question was, since we're going to have much less speed in seeing patients in the early opening, should we finally start thinking about changing our participation in vision plans? Any brief guidance there?
That's a great question. And I think this is an opportunity for all of us to pause and think about everything we do in the business, from even as hard of a conversation as this is, even with our teams. Statistically, there's lots of Gallup data that about 20% of our employees are actively disengaged, which means that they are not contributing to the well-being of our business, and in fact, maybe even damaging the business. And so you've got to make the hard decision. Maybe I take the FT penalty on the forgiveness side of the PPP and not bring everybody back or replace them. The same with our vision plans. Maybe this is an opportunity for us to reevaluate those plans and say, this one wasn't driving profitability to my business, and this would be a nice time to break away from that. Again, this is such a complicated issue. I'm in California. We're 70% VSP. I see lots of practices dropping VSP. That would be very difficult for a California practice to do that just because of our saturation out here. But from a principle standpoint, this is an absolute perfect time because 20% of our patients generally drive 80% of our revenue. And so it's possible you have some of those lower end vision plans that really are not contributing to the profitability of your business and just costing you money.
Mick, I want you to go to vendors as our last area of topic and allow time for questions at the end. But because this slide is up and you've put in a loan proceeds from stimulus in your projected revenue, you're getting a bunch of questions about the PPP. And so, that if that money is not there, first of all, that means that that's just that much more money you've got to either make in clinic or the way you've got to reduce expenses. But there's this sort of question around, okay, if my employees don't come back. Now, you sound like somebody who's really been thinking about this. Again, it's not all about PPP today, and I'm going to finish. This is going to be the last question about PPP, but talk about those who don't get it and what they need to think about financially, and talk about those who do get it and just the basics of what they need to do with their employees that are coming back, or if they don't come back.
Well, obviously, if you don't get the money and your employees are furloughed, I don't know that you have any other choice but to continue to have them stay on unemployment. In the example here, you can see you could not bring your employees back at full capacity if your practice is at 50% of its normal revenue and you don't have some supplemental income to afford them. So if I were in the situation where we did not get PPP funding, I don't think I would have any choice but to continue to furlough my employees. We did get PPP funding. And so our plan right now, and we don't have final guidance on how the forgiveness is going to be calculated. So we have not told our employees this yet, but our plan is to bring everybody back May 1st because we want to honor that intention of the PPP. And I might add, we had a Zoom call with my entire staff last week, and not one of them has even received an unemployment check yet. So just because we push them on unemployment, we might feel like, oh, they're making money, in some cases maybe more than what they made with us. They're not even getting unemployment. The unemployment system in California is so backed up that they actually have no income. That does not make me feel very good. And so I would rather bring them back as soon as I can and honor the intention of the PPP.
There's a lot of state variance on that. There's a lot of people that have published stories about businesses that have and haven't. I'll conclude that topic and let you move on by saying that you need to speak to your financial guidance team, particularly your accountants, about compliance with PPP and making sure that you expend the money in the right place. There's an expectation to bring a certain number of your employees, a certain percentage of your employees back, and there are certain triggers that would not allow you to get the money forgiven if you and to have it turned into a loan if you don't comply with those. So Mick, I appreciate your expertise on that. We'd like to get you to the vendor topic because that's a really important one for people who see their expenses stacking up.
Absolutely. Oh, absolutely. All right. So let's spend the last couple minutes and just go through this recovering with your vendors. So as I sit and think about all this list of people, I pull up QuickBooks every day and I look at all those bills that we haven't paid. And the first thing, hopefully, that you've done up to this point is that you've communicated with them. If we haven't said that, that's so critical that you make sure that you're communicating with your vendors and telling them in good faith that we have intention to honor the debt that we owe you, but for obvious reasons, we just don't have the money to pay you. We created a form letter that we've sent out to all of our vendors that said, listen, obviously I don't have to explain to you what's going on, but we have enjoyed our relationship with you, and we are going to do everything we can. And during the recovery, we're going to have to prioritize some of you based on the criticalness of how it impacts our business. But we are going to honor our obligation to you. And I think just having that relationship with your vendor and that conversation with them is really, really important. So we've got to get a list of all our bills. So just run a list. You can do this on a piece of paper as well, or through QuickBooks or whatever your software is. List your bills, how much you owe, and what's the least amount you can possibly pay them. And for a lot of them, it's going to be zero. In other words, think about the repercussion of some of our vendors if we just don't pay the bill. What are they going to do? Again, we want to honor that. We want to eventually catch up. But if for some reason I don't pay my electricity bill, my lights will get turned off. I better pay my electricity bill. If I don't pay a contact lens bill, or if I don't pay a frame bill, or if I don't pay a lab bill, that could get me in a little bit of a bind when we do open and I need to start using those accounts to order more products. So that would be sort of this tier of criticalness in the bills. And then the third would be all the things that if I didn't pay the bill, not a whole lot's going to happen in the short term. So just think about those three sort of priorities. So list all the bills, think about the minimum payments, create your 90-day projection, which we just talked to, contact those vendors and say, I want to create a plan with you. I've taken a look 90 days out, and here's what I think I can do for you. I'm going to attempt to make this payment on this month, then this next payment, this payment on the following month. Please don't hold this. These are projections. I don't know what the future holds, but here's what my plan is.
Hey, Mick, can I interrupt?
Yes, sir.
Sure. To whom at the vendor do you think a business owner should contact, right? Are you talking about their rep? You're talking about, an unknown 800 agent? I think it's very important to think about the mechanics of that. Could you offer some guidance?
Yeah, that's a great question. And the answer is, if you don't have a personal relationship with somebody that's a rep that you have a face-to-face contact with or have had in the past, I think you're forced to then go to the, faceless person in the finance department who's probably not going to be very empathetic or helpful to your situation? Maybe, maybe not, but I think I would start with the people that you have a face-to-face relationship with, because those are the ones that are going to go to bat for you on their side of the company. They're the ones that are going to say, listen, I have a relationship with this doctor. They've always paid their bills. They're good practice. He's told me in good faith that they're going to make good on these debts, and we just need to give him a little bit of a break. I think that you'll create an advocate if it's the people that you know. If it's not, I'm afraid you're probably just going to deal with the person that answers the phone in the billing department. Hey, there's nothing wrong with asking for the CEO's email address and just copying your email to the CEO and just saying, here's what our plan is. I just wanted to let you know. Take it to the top if you need to, if you don't feel like you're getting through to the person that you're dealing with in the billing department. Okay, so we contact the vendors, and then the last thing, we want to tackle the smaller debts. One of the things that I've learned about getting practices out of debt is, and this is straight out of the Dave Ramsey school of thought, of creating debt snowballs, and we can use this strategy also to get caught up with our vendors. There is a moral victory and an emotional victory that occurs when we pay off debt. And that when we pay off debt, that fuels us and gives us the energy to pay off the next one. And so if you can, try paying off small ones first. And I think it'll just give us an emotional lift and help us get to the next level. Once you've paid off those smaller debts, whatever you were using to pay off that smaller debt, if the cash flow will allow it, use that and roll it into the next debt. Once that second debt's paid off, we roll that payment, the total payment we were making there, we roll it into the third debt. That's called a debt snowball, and it's a way to really start accelerating the repayments. But I think a good strategy is start small. If you try to tackle that great big debt first and it takes you 3 months, you've got all these little things nipping at your heels that's nagging you, phone calls that are coming in, emails, aren't you going to pay your bill? And I think if we can just start cleaning our plate with some of the little ones, I know at least for me, that's going to make me feel a lot better. All right, digging out. So we may need to suspend some non-critical services. We talked a little bit about prioritizing those critical vendors. Any vendor that's required for you to do business, and for us, that's our lights and our rent. It's the products that we sell, contact lenses, glasses, frames. Those need to be given the attention first. Everything else we can push on the bottom, unless there are a few little ones that we can knock off. But from a sort of a strategic standpoint, those are the ones that we want to give the most attention to. Now, those might also be your biggest bills that you have to pay. So you might be thinking, well, you just said pay the little ones first. When I say prioritize, I mean give attention to them. Give them the first bit of your attention about your plan of recovery, because they may tell you, hey, listen, no problem. Why don't you make your normal payment now and give me an extra $1,000 on top of that for the next 4 months or 6 months or a year or whatever the case may be. We don't know all the available strategies and offers that could be there with our vendors. So when I say prioritize, it doesn't necessarily mean pay them first, but prioritize them because you don't want to jeopardize your relationship with them, because you need those products to drive revenue in your business. And that leads us to the third thing, which is drive revenue. Anything and everything you can do to get your income number up is going to obviously offset your expenses in your practice. All right, I want to wrap up with just another couple of quick thoughts, Scott, and this is something I've been thinking a lot about as well. And here's what it is. We have a new reality that we're facing, and this is really, really critical. I work with many practices, and I have rarely ever encountered a practice that didn't say to me, you know, Mick, I run a really lean practice. Everybody thinks they run a super lean practice. The reality is most of us don't. And that's because most of the time the doctors are not the ones spending the money. It's our staff that's making a lot of buying decisions, whether it be frames or lenses or things like not getting discounts on second pairs from your lab, or possibly not following up on remakes that we got charged twice for. Things like that are consuming cash in your business. And so we have to change our mindset about the expenses in our business. And so what we want to do is we want to sit down with our team. We want to identify anything that is not driving profitability in our practice. Any expense that we have that is not driving revenue and profitability, we want to consider getting rid of it. We want to replace or renegotiate with our vendors any comparable service that we possibly can get. And I'm going to show you this guide that I use with some of my coaches and also in our practice. And we pull out the profit and loss statement every single month or every single quarter, and we challenge with my leadership team every single expense in our practice. And we literally write down every expense that occurred in the last quarter, and we put a check mark by the P if it's profitable, if it drives profitability in the practice. We put a check by the R if it's renegotiable, and we put a check by the U if it's unnecessary. And then we assign somebody to go tackle the tasks of contacting the vendors that have used by them, and we just get rid of them. We just fire the vendor, say, I'm sorry, that is something that we don't really need right now. We're going to have to end that relationship for now. Anything that's got an R by it, someone gets the task of contacting the vendor and renegotiating or replacing it. And then finally, anything with a P by it, we leave it alone, because we don't want to jeopardize things in the practice that are driving profitability in the business. And the majority of the U's and the R's are going to happen over here in this things bucket. All these marketing expenses and insurances that we can renegotiate, and our IT expenses, maybe we can get a better deal on our managed services. It just goes on and on and on, all the things that we can get aggressive with our pricing. So I think this is going to be the new reality. And I want to just say it one more time. Put a P by everything that's profitable, R by everything that you can replace, and a U by everything that's unnecessary. And we want to do this every single quarter and continue wringing the towel and making sure that we're getting as lean as we can. Because the profitability of our businesses has been thin, and we've got a lot of catch up to do. So we've got to make sure we get that profitability up. And then, Scott, the last thing I'm going to share with you is something called loss aversion. And what loss aversion means is that we are biologically hardwired not to give something up once we've been given that something. Okay, what that means is that in order for us to sustain ourselves as a species, we have been hoarders. I have an entire garage full of things that my wife and I, to some degree, am guilty of hoarding, and we hold on to it for irrational reasons. And that's called loss aversion, because we have an emotional attachment to that, and we don't want to give it up because we have this fear of needing it. When you go through the process of challenging the expenses in your business, you are going to experience significant loss aversion, and you are going to find every excuse in the world not to give up an expense in your practice. But stop for a minute and think about how irrational that is, because a perfectly run business would have zero expenses. So why would we not be doing everything we can to get rid of every expense in the practice? And the reason is it's almost always driven out of fear. Fear that we might need that vendor. Fear that I'm going to feel stupid because I made a bad decision. Maybe the vendor is a friend of yours and you're embarrassed to tell them you can't afford their services anymore. But that emotional connection to loss aversion is going to inhibit you from getting rid of stuff. And that's why I want you to get your staff involved, because they can help you remove the emotion from squeezing expenses in your practice, because the new reality is we have to be way leaner than we have been up at this point. So guys, thank you so much. I'm going to throw this last slide. It's just got my contact information up there. Scott, I want to tell you, if there are a few more questions, I'll hang out as much as you guys want. But I really appreciate the opportunity to share with you guys today.
The primary question that you can answer is there's a lot of questions about the resources you've displayed, spreadsheets, you're eradicating your expense checklist. Would anybody who needs those things or would be interested in them just simply email you and have a conversation with you about that?
Just have them email me. There are some things that I can obviously, I'm at liberty to share. Some things I've created specifically for Vision Source, and so I need to make sure I reserve those for the members of the Vision Source organization. But if you have any questions about any of these tools that I can share, I'll be happy to share those with you. Just drop me an email.
Okay, you may get plenty of emails. Everyone was very appreciative of the kind of graphs and the kind of spreadsheets and such you created. So very grateful for that. We're going to have a recording of this available soon as well, so everyone can rewatch and fast forward to the parts that they want to take a look at again. So with that, I'll say that it's wonderful that we had such an incredibly high attendance today. We had this goal of giving you some of these concrete plans that Mick talked about to assess your financial status for both an income and expense side so you can make the best of your 2020 finances, and really grateful for your practical insights, Mick. We're going to have an email announcement of our next step webinar that's coming next, so please watch your email inbox for that. And maybe the closing comment, Mick, is Dr. Lori Lippiatt was our guest on a couple of webinars already, and we talked about setting loss aversion is an interesting phrase. I'm thinking about how you talked about that. Setting a bar of expectation for ourselves that maybe breaking even is good enough this year. You kind of got me to think that maybe we can be better than that. And so before we say goodbye, why don't you give us, just a quick comment on what should our goal be?
Yeah, that is such a great question. Yesterday, I had the opportunity to do a Vision Expo webinar, and I had a group of panelists on with me. And my good friend Gina Wesley said to me prior to the webinar, she said, I think one of the things important that although we're all trying to get a lot of things accomplished right now, there's almost a sense of obligation that we have to be bringing in telehealth or bringing in some new product or new service or doing something with the downtime. And she reminded me that just surviving is good enough.
Mm-hmm.
And I felt such a sense of relief for that, because I've been so busy with all the other things I've been doing that my own practice to some degree has been somewhat neglected with some of the things like around telehealth, and we just haven't really implemented that. So just surviving is okay. Getting yourself out of the desperation stage 2, into evaluation and then into some planning, I think is really the most important thing. So just give yourself a break.
It means a lot to me to hear you say that. I think that would, I was like everyone who stuck around to the last minute of a webinar to get something out of it. I appreciate everyone sticking around, but I would emphasize that one more time. Exist, right? Compete this marathon to complete it. It's not about setting a personal record. It's not about being better than anybody else. Nobody wins the game of optometry and business management. What they do is make steps to control what they can control. And I think you're all well versed and well able to do that, and in large part because of your contributions, Dr. Kling. With that, I'll say thank you to all attendees. Goodbye. Be great at all you do. We'll see you again next time.
Thank you.